We've got BNP Paribas Chief Asia Economist Rishaad Iley with us. Richard, great of you to come in. Let's just talk a little.
Good to be here.
Yeah, let's talk a little bit about where we are with the US now. I mean, we just keep on going over the same thing. It's like deja vu all over again.
It is. It is. I think it's important to distinguish between what's going on the policy front, particularly the continued wrangling of the politicians, and actually the underlying macroeconomy, which, despite all the pessimism out there, isn't doing too badly, certainly in my view.
Are you talking about the US here, particularly?
Talking about the US,
yeah,
absolutely.
Corporate America is not creating jobs, though. At what point does it?
Well, I think what we've seen is some pretty weak jobs numbers over the last couple of months. I think there's good reasons for a degree of scepticism about just how weak those numbers are. Not all of the indicators are pointing in one direction.
They have improved, I'll give you that.
Point I'm emphasising to clients, take a look at the employment balances in the ISM surveys, both manufacturing and non-manufacturing. They're both at levels actually consistent with reasonably healthy hiring, probably 150 to 200,000 jobs a month.
So is that something which presages
yeah, sure.
Job creation in the months ahead?
I think it does. I think it does. And so probably, horrific as the numbers have been, they're probably as bad as it gets. We may even see some upward revisions to these numbers, particularly that shocking 18K number we had at the end of last week. The other shard of sunlight, if you like, in the gloom, last night's initial jobless claims numbers. Call it poverty of expectations, but they did fall back towards that 400,000 watermark. Again, I think presaging slightly firmer numbers moving forward in the next few months. I think the key for me, though, Rish, is that what we've had is a big oil price shock this year. And that has slowed the economy. Price of gas,
as we did in 2008 as well.
Exactly. The price of gas for the US consumers pretty much gone up from just below $3 a gallon up to almost $4 a gallon a couple of months ago. That is now coming off. Even though oil prices are still uncomfortably high, the price of gas is already down 30, 40 cents a gallon.
Effectively an interest rate hike, isn't it?
Yeah, it is. It's been a very big disposable income squeeze for the US consumers, worth something like 1% of GDP over a quarter. So you annualise that, it's a big hit. That has been a major headwind. That is now going to turn to a tailwind second half of the year. That's why I think we can be a bit more optimistic about the US.
But the mood music coming from the politicians is not nice.
No, it's not. And obviously they need to do a deal. And if they don't do a deal, we're going to be in a lot of trouble, I think. I think that's universally accepted.
How does this all play out for Asia, especially, with Ben Bernanke saying that there's more risks towards inflation rather than deflation now? Does that rule out another round of printing of money?
I think it does, and I think it's very good that he clarified that more clearly yesterday. We thought that the market reaction to his initial...
He was a bit too open there, wasn't he? He was leaving the door right open for any interpretation of what he said.
Yeah, we thought certainly markets overreacted to the comments he made on the first day, which was simply that, look, there's a lot of uncertainty in both directions. If the economy takes another lurch down, we don't recover from this soft patch. As I was saying before the break, I think we will. And if inflation turns south again, then yeah, QE3 is on the table. And I think it's important that optionality is out there for markets. I don't think we should have been surprised by that. What he did last night was clarify the situation, I think, for everybody, making it very clear that, look, core inflation right now, running at an annualized rate of about 2.5%. A year ago, it was running at an annualized rate of about 1%. That was the essential background for QE2. Fundamental situation on inflation very different right now. So QE3 off the table, we think, certainly for the foreseeable future.
All right, what about Asia then? How do we interpret it? And what are markets here, do you think, pricing? What are they pricing in?
Well, I think there's a number of moving parts here, Rish. I think one point that I think is very important to emphasise is that until recently, the concern really in Asia has been that growth has been too strong. That we've been dealing with fears of overheating, over-tightening by authorities to deal with inflationary pressures. At the risk of sounding a bit Panglossian, if I can use that term.
Real broadcast word that is.
A bit too optimistic. Well, if you're going to act like a weatherman, I can slip in Panglossian. It does look as if fears of a harder landing that might be required to knock out inflationary pressure in China have dissipated somewhat. And I think that's very good news. And we are seeing Chinese equities at the margin outperform consistent with that. The data this week has been very important. We had Q2 GDP and industrial production data, both somewhat better than than expected. Equally, we know that inflation is very high today in China. It's nearly 6.5%. But there's every expectation it's going to come down.
Food inflation is even higher.
Yeah, but that's the key point.
Yeah.
It's basically food inflation. We think it is temporary. We think it is ephemeral. It is going to be transitory. It will come off quite quickly in the second half of the year.
That doesn't stop the fact that it remains expensive, though, and food takes up that much bigger a portion of the people's food, whether the basket that they buy. And so, you know, unless wages keep on going up, which is actually also inflationary in itself, isn't it?
Yeah, and I think the big picture for China is that it is slowly rebalancing. The tightness of the labour market, the fact that it doesn't have the big reservoirs of labour ready to flow into the cities that perhaps it did 10 years ago, means that we are seeing more sustained upward pressure on wages and costs. And that ultimately is healthy. That's going to rebalance the Chinese economy away. But the big inflationary problem has been food, as you say. That's adding something
that's everywhere.
like...
That's across the region. But, you know, who do you worry about most?
This is going to come off.
But who do you worry about in terms of the economies? I mean, not everybody can be growing like China. Well, do you have concerns for any of the other economies in this part of the world?
Well, I mean, the other 800-pound gorilla in the room in the region, at least as far as I'm concerned, is India. That's the only other economy that rivals China in terms of population and in terms of potential growth rates. There, we've been consistently saying all year we are a bit more worried about inflation on a sustained basis. India
cost
seems
of borrowing
to have,
is just enormous compared to other nations around this part of the world.
Yeah, but it's a very high nominal economy. I mean, nominal GDP growth last year over 20%. In India. So relative to that type of nominal framework, the level of rates isn't especially high. But I think the bottom line for me on India is that it's got the elements of a structural inflation problem, rising incomes, lifting demand for food. We're not convinced that food price inflation will fall back as quickly as, say, it will in the second half of the year, say, in China, as it will in India. And the economy's been very hot, as, say, China has been in the first quarter of this year as well. So India's got this rather unfortunate conjunction of the structural inflation problem overlaid with a cyclical one. It's the latter that we think the RBI are going to have to continue to deal with, which means rates are still going to have to go up.
Yeah, and they're going to go up. And what are dangers of them choking off the growth then?
Well, I think the risk of a Hardish landing for India has definitely risen, and that's been something we've been emphasising to clients really for 3 months now. I mean, it's very simple, Rish. I mean, if you go above capacity, you generate overheating cyclical inflation pressure, you're going to have to come down below. Now, for India, that means probably multiple quarters of growth, certainly with a 7 handle, maybe even a quarter 2 of growth with a 6 handle. And in Indian terms, and they've been used to growth rates of 8, 9, even 10%, that is a Hardish landing. Of course, from an American perspective, you're thinking 6, 7% growth. Come on.
Yeah, exactly.